That was great.
All
And
right.
now we're pretty excited to be welcoming Dan Bortolotti to
Absolutely.
join us for the first time, but not the last time.
All right. Well, it's great to be back. Thank you.
Hey, Dan. The Spud is back.
Spud, yeah.
So back when I was doing the Canadian Couch Potato podcast, we had a popular segment called Bad Investment Advice, where
Bad investment advice.
I used to look at articles, videos, blogs, etc., that offered truly awful suggestions for how you could manage your personal finances. And we thought it would be fun to kind of resurrect that segment because there's certainly no shortage of bad investment advice still out there. It was an interesting segment that we used to sometimes look at advice from investment professionals that was very obviously done for marketing purposes. It was manipulative. It was self-interested, something I really enjoyed calling out. Other times it was really just from amateurs, and there was no ulterior motives or anything. It was just naive. But in many ways, I think it's just as harmful because a lot of these amateur DIY investors have a lot of followers. So that's the category of bad advice that we're going to target today. And the article in question is one called An Interesting RRSP Idea, All in on QQQ.
Z, 4, Q, another Q, a third Q, and the Batman symbol.
Now, I'm going to unpack exactly what that means in a minute, but before we do, I just want to say I'm not going to identify the author or even the website that the article came from because I have no interest in personal attacks here.
Right.
It's not about that.
Yep.
It's really just that, he's a DIY investor. There doesn't seem to be any ulterior motive, but it's still pretty dangerous advice. So I think it's helpful to pick it apart.
Yep.
Agree.
So the main point of the article is he makes an argument that might make sense to hold nothing but QQQ in an RRSP. So let's clarify all this straight away. What the heck is QQQ? It's the ticker symbol for a very popular ETF from Invesco PowerShares that tracks the NASDAQ 100 index. So the NASDAQ 100 is an index of the 100 largest non-financial US stocks. So it includes companies in the banking, insurance, mortgage, investment sectors.
Sorry, it includes or excludes?
Excludes. I'm sorry. So it's made up of all of the other sectors in the economy except for financials.
Right.
Now, in Canada, financials make up a huge part of our index. In the US, they make up about 11% of the market, which is a relatively large category. But you might think that if you just excluded that 11%, it wouldn't make very much difference. But in fact, there's some pretty huge differences between the NASDAQ 100 and the larger US market. So tech stocks, for example, make up about 33% of the broad market in the US, but they make up over 51% of the NASDAQ 100. And of that, even the top 10 holdings, which as you can imagine, are Apple, Microsoft, NVIDIA, Amazon, Meta, Alphabet, the usual suspects. They make up half the index. So
Amazing.
let's understand here, we're saying the top 10 holdings have the same influence as the other 90. Now, the US market is already very top heavy. The 10 biggest stocks in the S&P 500 are about 30% of the index. So concentration is not really unique to the NASDAQ 100, but this ETF, QQQ, takes an already pretty significant problem and just makes it all that much worse. So if it's such a big problem, why is this author recommending that we go all in on this ETF for his RSP? And you've probably figured out, we're talking about tech stocks. I mean, they've been the heroes of the last few years. And what we're seeing here is just flagrant performance chasing. I mean, he's pretty explicit about it. I'll just read from the article directly. He says, why would we consider going all in on QQQ? Because QQQ has done very well historically compared to the major US and Canadian indexes. In the last 20 years, QQQ has had an annualized return of 14.03%, and an annualized return of 18.12% in the last 10 years. Now, so very tempting returns. I think we can all agree on that. So why not go all in, put your entire RSP into QQQ and expect another 14% annually over the next 20 years? So this is really a great example, I think, of when you need to look at the period of performance that somebody is, holding up as an example. Now, I don't know whether the author did this intentionally. I don't think so, but it's certainly convenient to say the last 20 years because that period would have started in 2004. And for those of you not old enough to remember, there was a little event called the dot-com bubble that occurred just before that. So to back up from the mid 1990s until around March of 2000, the tech stocks in the NASDAQ 100 had a tremendous run, even better than what we've seen in the last 20 years. And guess when QQQ was launched? 1999, right?
Remember it
Very
well.
close to the peak of the bubble. So it's not surprising for ETF providers to create products to exploit past performance. And I would not be surprised if more than a few people went all in on the NASDAQ in 1999. Well, we know what happened then. Over the next 2.5 years, from early 2000 to about 2003, the NASDAQ 100 lost more than 75% of its value. So you were pretty close to being wiped out if you were all in on that strategy during that period. Now, let's be clear. I'm not predicting a tech crash. I'm not calling a bubble. I don't do that. But anyone who understands the most basic stock market history knows that individual countries, sectors, companies will enjoy a period of exceptional outperformance, but it's not sustainable indefinitely. So if you're going to make a recommendation to go all in on QQQ based solely on past performance, you can't really sidestep the decline that would have devastated people who had followed the same strategy in the late 1990s and early 2000s. All right. And I do want to be fair to the author. He does acknowledge that QQQ, it's one of my favorite lines. He says it's not all that diversified, which is an understatement to say the least. And he does note that even after the crash, the fund didn't recover for about 14 years. So it's acknowledged, but it's a token few lines. And in fact, another of my favorites is he says that the biggest case against this strategy is that it would take a big hit to his dividend income because these tech stocks don't pay dividends. I think the risks are a little more significant than a reduction in your dividend income. So, look, there's no perfect investment strategy. We can all agree on that, but there are a lot of terrible ones. And I think at the top of the list of terrible investment strategies is choose one economic sector in one country that performed the best over the last 20 years and then bet your life savings that it's going to be repeated over the next 20 years. So you could have made similar bets with Canadian bank stocks, with Vancouver real estate, which a lot of people did. And it worked out really well over some periods. But it's very naive to assume that, in the whole universe of investments, your best hope of success is to concentrate on a very small number of stocks in the same industry, in the same country, exposed to the same risks. So I want to propose another interesting idea for your RSP. How about diversifying across every economic sector, every investable stock market in the world? And while you're at it, maybe throw in some bonds and GICs as well. So just to give you a little bit of context and compare that strategy to the all-in on QQQ strategy, have a look at a fund like Vanguard's VEQT. It's one of the popular global equity ETFs out there, holds over 13,000 stocks, large, mid, small companies, 51 countries. And yeah, it holds all those same big tech stocks too. Nobody's saying those shouldn't be part of your portfolio, but it also has a 20% allocation to financials. It has a 13% allocation to industrials, consumer discretionary. Every other sector is in there as well. So as far as I'm concerned, instead of going all in on QQQ, I would rather go all in on global capitalism.
Love it.
The EQT and chill.
Yeah.
Exactly.
Or in my
Right.
case,
This is like some of the most common bad advice, though. It is everywhere. I see Reddit posts all the time of like, should I add some SPY to my QQQ for diversification? It's like, man.
There is
Yeah.
definitely a tendency to see people doubling up on holdings. You know, like you said,
Yeah.
holding the S&P 500 and the Nasdaq, forgetting that all the Nasdaq stocks are also in the S&P 500.
Yeah.
You're just buying more of the same, right?
I'm glad
There's-
you
there-
referred back to the downside that happened back in the early 2000s, that 75% drawdown. It takes some conviction to stick with that 25 cents on the dollar to ride it back over the next 14 years just to get back to break even.
Yeah.
I don't imagine a lot of people would have had the patience to do that. And in fact, I've talked to, investors who are a little bit older who have said, it took them a few years just to get back into the stock market, period. At that
Exactly.
point. They were so scared off the whole idea that they were all out for a few years. And of course, when that happens, you're going to miss the early recovery. You'll eventually get back in, but the early recovery is where some of the biggest gains occur.
So there's a 2007 paper in the American Economic Review by Ilya Daichev where they look at the difference between buy and hold returns and dollar-weighted returns for a bunch of different markets and indexes, including the NASDAQ. And so it's basically like the performance gap for these different indexes. It's older, they look at data ending in 2002 in the paper, but the return gap for the U.S. market for the NYSE Amex was 1.3%, but for the NASDAQ it was 5.3%. So it kind of speaks to
Annualized?
yeah, that's right. Big return gap.
Yeah, it's not surprising. It's
No.
while you guys were, Dan, while you were discussing this, I just pulled up Y charts and looked at MSCI World, which essentially tracks in US dollars the entire mostly the entire global stock market versus QQQ, and just kind of shuffled the periods around, right? Looking at 20-year periods. And to your point, if you look at 2000 to 2019, MSCI World outperformed QQQ, right? And like Ben, Cameron, you guys have seen this back in like the mid 2000s, late 2000s. You have the lost decade in the US. Nobody's talking about going all in on US stocks or all in on QQQ. They're talking about, if you're not, 50% emerging markets, then you don't know what you're doing, right? So it's just this flavor of the day. Like if it was only as easy as looking back at the last 20 years and buying what performed the best, then, we'd all be very wealthy people. It's not that simple.
Just need a time machine and you'd be the ideal investor.
Oh, can you
Yeah.
imagine?
But there's a great narrative around this too, right? Like if you talk to people who are doing this, their viewpoint, I find, this is totally anecdotal, but is that investing in technology can't lose, right? That all companies are becoming technology stocks. The stories, the narratives behind the Magnificent Seven are just so compelling and so obvious to people that these are the companies that are going to dominate for the next 100 years. And even if that's true, though, you have to look at price. Like if that's so obvious to everybody in the market, why would we expect higher returns from those stocks in the first place, right?
Well, and I would argue in that sense too, it's not that AI or other technologies won't be transformative, because I'm sure they will be, but we don't know how. And it may not be that the biggest winners in this game are the technology companies themselves. It may be companies in other industries who transform the way they do business because of those new technologies. And we don't know what those might be. Maybe they will be financial companies. Maybe they will be insurance companies. Maybe they'll be automotive companies. We don't know. But if you hold everything, then you know that you're going to have the winners in your portfolio.
Yeah. And Ben, you've done research on investing in technological revolutions, right? And it's just not that obvious that you should be always investing in the hottest trend, right?
It's more than not that obvious. It's usually pretty bad investment outcomes that people get for investing in the newest technology.
I listened to a podcast this week interviewing an expert in the whole world of AI and LLMs. And the difference between this revolution and the revolution in the late 90s, early 2000s is that the amount of investment it takes to continue to get the scale. Is it Moore's Law, like that doubling of output is just unbelievably massive if you believe that scale is going to continue. So that's a big difference this time around. What that means for markets and returns, I have no idea, but it's a very different environment.
Having said all that, I did buy TQQQ in my son's little test account that I have for him. TQQQ is triple leveraged QQQ, which he's 6, right? And I have a little Wealth Simple account or whatever. I'm trying to teach him about like volatility in stocks and stuff. And I was like, all right, let's amp things
That
up.
may do it.
Yeah. Yeah.
He
who
does
knows?
have the time horizon on his side anyway.
That's true. That's true.